Let's just take a look at those banking sector stocks. They're falling over the week and large declines there. If we had a look at Equity Bank, it fell 3% on the week to 24.75. Barclays gave up 2% to 16.75. KCB was down 1%. Co-op Bank, Diamond Trust falling 2.5%. Why have investors been selling off these stocks ahead of their second quarter results?
Well, I think it's a question of these stocks trading way past their books closures. Most of them have already paid out the dividends. So what we are seeing here for most of the banks is selling off. People are selling off, and again, we've had a lot of activity from retail investors locally selling off because they're trying to raise capital from the market. And also looking at maybe some of the counters like Barclays Bank, it's correcting now because it had been split by 4 earlier last month. So what it's trading at is more or less what it's actually meant to be trading at.
Now let's just take a look at the news that KCB has increased its lending rate from 13.5% to 15%. This is quite a large jump, and it indicates that the spread between the savings and deposit rate and lending rates is still quite substantial. What impact is this going to have on customer behavior and bank margins going forward?
Definitely this spells tough times ahead for the banks, whose main source of revenue comes from their credit services. But we must understand the situation, and it's because of the high inflation rate in the country right now. We've had central bank moving in to also adjust its rates accordingly to kind of squeeze the credit out of the market. They're having a contractionary monetary policy, and I think this will affect the banks because they'll also be forced to maintain the deposit rates, the cost of funds at the same time, so that they can lure the clients and keep growing. But looking forward, I think it will be a major challenge for them.
Looking at the banking sector survey that was released last week, Equity Bank still has the largest number of customers at around just over 33%, but its market share fell 2.3% to 45.7%. Now, if you contrast this to the likes of KCB, its market share growing 11.3% at this stage. Its counts grew 78.4% to 1.34 million customers, and that's from 750,000 customers. Does the likes of KCB, which fell last week in line with all other banks, represent a good investment case?
Well, Equity Bank has had a very unique approach. They've focused more on retail, and I think that's where they get most of their revenues. You're looking at KCB, this is a bank that has been established from way back. They have a wide presence regionally, they have a wide presence in the country, and also looking at the management plans they have had also to streamline their staff. They are working towards improved output, reducing their cost to income ratios. So I think what has really hurt Equity Bank more than anything else is competition in the retail banking sector. And we have seen quite a number of small players emerging. We've had the likes of Family Bank, we have the likes of these other smaller banks, the low tier banks, and this is actually putting a lot of pressure on the popular names like Equity.
Let's move on to some of the losers on Friday and for the week. Kenyan took a battering. It was down 5% to 12.90 shillings. And Access Kenya, as I earlier mentioned, down over 10% on the week. Is there anything to take out of these significant moves for downwards?
Kenyan, I think, is one of the undervalued stocks in the exchange. It can still perform much better. They have been involved in a number of projects, clean energy projects. They have received a lot of funding. So we are yet to see these projects mature probably in the next 1 year. And I think at 15, lower than 15 shillings, about 13 shillings, it should be quite a cheap stock to get in. They also have their year ended in June. So as we await for their full year results, we expect something good. They usually have a high dividend yield. Based on that, we are likely to see an increase on activity on that count. As for Access Kenya, they are moving from loss territory. They've been having some management restructuring. we expect them to also come back, to have to make a comeback in the market, and that's the price it currently trades at. I think it's an attractive buy.
Could we be expecting better performance on the bourse this week ahead of the listing of TransCentury later in the week? What type of catalyst is needed to turn this market performance around?
I think the main issue here is looking at the market from a macroeconomical perspective, and I think that's what has really affected the market. We've had people with less money for investment, and I think that's what has shut the retail investors out. We now have the IPO for British American underway. We also have TransCentury by way of introduction. These two are expected to rejuvenate the market, but all the same, we may need something more than that. And perhaps with the coming of the corporate actions for the banks half year, we may see this.
Robert, very quickly, one top stock pick for the day?
I'll stick to Barclays. Barclays has been my favorite since the time they split. It has been trading at a discount, actually at 16 shillings and 80 cents, and I think it still has a lot of room for growth. I can't wait for the half-year results. I think there's a lot of shareholder value to be drawn from that.